Hello, everyone. Welcome to the webinar on Hong Kong, the ideal international hub for asset and wealth management, organized by the Hong Kong Trade Development Council. My name is Fiona, and I'm pleased to be your MC today. With introduction of the limited partnership fund regime, enhancements to the open-ended fund company regime, and the passing of tax concession for carried interest in the past 2 years, Hong Kong's role as an international hub for asset and wealth management has been further enhanced. Our webinar today will discuss how these initiatives and the current market landscape create a favorable environment for asset and wealth management companies to conduct and expand their business in Hong Kong. We will first hear from Hong Kong regulators and professional service providers in the sharing section. And then we will have local and European industry practitioners in the panel discussion. During this webinar, you're welcome to raise questions in the Q&A box. Selected questions will be asked in the Q&A section towards the end. To elaborate more on Hong Kong's OFC structure and LPF regime, we are pleased to have Ms. Grace Chen, Director of Investment Products from Securities and Futures Commission, and Mr. Anson Law from Market Development Division, Hong Kong Monetary Authority, to share with us the latest development and the future prospects. Without further ado, may I first invite Grace to start her sharing first. Grace, please.
Okay. Hello, everyone. Good afternoon and good morning to those joining from Europe. Nice to meet you all. So before I begin to introduce the our new OFC regime, maybe I'll just I'll put on the slides here. Okay, maybe I'll just give you some background on the figures and landscape of the Hong Kong asset management industry, so that we can put everything in context. So I'm just checking out. Can you see the screen?
Yes.
Okay, great. Okay, so according to our annual asset and wealth management activity survey, Hong Kong's total asset and wealth management business stood at over 35 trillion in 2021, out of which our asset management and fund advisory business amounted to more than 25 trillion. This represented actually an 8% year-on-year increase, and the total net fund inflows for our asset and wealth management business also increased by 6% last year. Our survey indicated that non-Hong Kong investors remained a major source of funding for the asset management business, accounting for 65% of the total AUM. So we can see that despite the challenging environment facing many markets last year, Hong Kong's asset and wealth management business remains resilient, and Hong Kong has continued to be a popular asset management hub among overseas investors. In terms of our Hong Kong capital market, as you may know, Hong Kong is a well-established and popular listing platform and IPO venue. In fact, Hong Kong has topped the world in IPO fundraising for 7 out of the past 13 years. Hong Kong has also benefited from its unique positioning and connectivity with the mainland, and Hong Kong is in fact the world's largest offshore, has the world's largest offshore pool of renminbi funds, where over 70% of global offshore renminbi payments are processed here. The Stock Connect and Bond Connect schemes that we have actually brought about trillions of fund flows between the two markets, Hong Kong and the mainland. And we're also very excited to see the launch of the new ETF Connect this year, which I will elaborate a little bit later. So coming back to our new OFC regime, the introduction of the regime in 2018 is actually one of our very key initiatives to enhance our market infrastructure and to further develop Hong Kong as a fund domicile. Introducing this corporate structure can give fund managers more flexibility in terms of choosing fund vehicle choices. As at the end of last month, we have a total of 284 funds already established, under 101 OFCs to date. These included 29 ETFs listed on our stock exchange with a total market cap of over 8 billion Hong Kong dollars. In fact, our structure is suitable for different types of funds. We can be used for public funds, private funds, listed, unlisted, closed-end, and open-ended funds. So far, we have seen our OFCs established. They have adopted a very wide range of investment strategies. We have seen them investing in traditional equities and fixed income instruments. They're also OFC established to invest in kind of more the newer type of investments like AI, mining, ESG, and healthcare. And in terms of geographical spans, we can see that the investments cover basically around the world. So this slide shows the figure showing the basic structure of an OFC, which is basically a collective investment scheme structured as a company with variable capital. We have the OFC board consisting of individual directors. They are not required to be licensed by us, but they owe fiduciary duties to shareholders just as directors of conventional companies. The investment management functions have to be delegated to an investment manager licensed by the SFC, and there must be a custodian to safekeep the assets of the fund for investor protection. So this is a structure pretty much similar to other corporate fund structure you see overseas. So actually, after the rollout of the regime in 2018, we have kept a continued dialogue with the industry participants, and we've made various enhancements to our regime as a result of their feedback, as shown on this slide here. So, for example, we have further streamlined the regulations on private OFCs. We've removed all the investment restrictions for private OFCs, and we've also allowed more people like the brokers to act as custodian of private OFCs. Last year, Hong Kong government rolled out a grant scheme, which is first of its kind, to subsidize the cost of setting up OFCs. And that's I'll elaborate a little bit later. Last year, we also rolled out the statutory redomiciliation mechanism for OFC, and which can facilitate overseas corporate funds to migrate to Hong Kong as an OFC. We know that this is very important, and because we understand that, for offshore funds, they're actually facing increased scrutiny and costs because of OECD's economic substance requirements. So with this statutory framework being put in place, overseas corporate funds can have more, certainty from the legal and tax perspective while moving their funds to Hong Kong. And the regime can also help preserve the track record of these funds, which we understand is very important to fund managers. So as a result of all these enhancements, actually, we are very happy to see a significant increase in the uptake of this new vehicle in the past 2 years. So what are the key benefits of setting up OFCs in Hong Kong? Using an onshore structure like an Hong Kong OFC, it definitely can save management time and costs because you'll only be dealing with one jurisdiction, and you can avoid an extra offshore, layer of service providers being, have to be engaged, and of course that will incur, meaning you have to incur extra costs. And also for our OFCs, actually, our fees are very competitive. For public OFCs, actually, we're not charging anything extra apart from, seeking, to authorize a normal fund for public offering in Hong Kong. For private OFCs, we are just charging a very basic registration fee, which is about 1/6 of our public funds. There's no annual fee, and we will just be charging post-registration fees on a per change basis that, changes that we require approval. Actually, we're just charging like 300 Hong Kong dollars for each change. And actually, there are only 4 changes that will require the SFC approval. So we have a very, very competitive fee structure for our OFC regime. In terms of the process, we adopt a one-stop application process and a very streamlined regulation for OFCs. And we try to process all the applications very efficiently. And at present, I think generally for private OFCs, we can approve applications generally within 14 business days after we've taken up the application. So there would be no annual returns required. There's no mandatory AGM, no annual fee. So we hope that this can give practitioners and fund managers a very streamlined, kind of efficient service. And we also believe that investors setting up OFCs in Hong Kong. We also believe that investors will have confidence in our regime because Hong Kong has a very robust regulatory regime adhering to international standards. In terms of market accessibility, Hong Kong OFCs can benefit from the new Greater Bay Area Wealth Management Connect scheme, which allows eligible mainland Hong Kong and Macau residents in the GBA region to invest in wealth management products distributed by banks in each other's markets. So this can create a lot of new business opportunities for the financial industries in the three places. Hong Kong OFCs can also benefit from the new ETF Connect, which was launched in May this year, which allows mainland and Hong Kong investors to trade eligible ETFs listed on Hong Kong and mainland markets respectively through their local brokers. Public OFCs are also eligible under the scope of our mutual recognition of funds arrangements with other overseas jurisdictions like France, the UK, Lux, and the Netherlands, and also Switzerland. So all these initiatives and connect schemes that we have put in place can help to broaden the investor base of our Hong Kong OFCs and basically our Hong Kong domicile funds. Okay, I mentioned the grant scheme. So to encourage the uptake of this fund vehicle, the Hong Kong government has launched a 3-year grant scheme last year to subsidize the costs of setting up an OFC in Hong Kong. Knowing that it's a new vehicle and people may need to learn, the new rules, and this is new. So basically under the grant scheme, investment managers who have successfully incorporated an OFC or redomiciled non-Hong Kong fund corporation in Hong Kong as an OFC can apply for the grant. And the grant amount can cover equivalent to 70% of the eligible expenses for each application, subject to a cap of 1 million Hong Kong dollars per OFC. Each investment manager can apply for a maximum of 3 OFCs. So actually it's a pretty generous grant. And eligible expenses, what we mean, that's basically the expenses paid to Hong Kong-based service providers in relation to the incorporation of the OFC and the redomiciliation of non-Hong Kong fund corporation in Hong Kong as an OFC. So the grant scheme will be administered on a first-come, first-served basis, but I can assure you that we do have funds available. So if you apply and for incorporation of OFC now, you will be eligible for the grant. Last but very importantly, I want to mention the recent tax initiatives that Hong Kong has rolled out in the asset management space, because we understand that tax consideration is actually a very important consideration for fund managers in terms of choosing the fund domicile. So the Hong Kong government has rolled out various tax initiatives in the past few years to facilitate the asset management industry. And this can actually demonstrate a very strong policy intention that the government will support Hong Kong as a premier asset and wealth management center. So in 2019, actually, we have rolled out the new unified profits tax regime for funds to provide profits tax exemptions to eligible onshore and offshore funds alike, regardless of their structure and size. So in the past, only offshore funds are eligible to tax exemptions, but now both onshore funds, including OFCs, and also offshore funds are actually subject to the same profits tax exemptions, benefits. Last year, we've also rolled out a tax concession regime for carried interest distributed by private equity funds operating in Hong Kong. And later this year, we'll be introducing a bill to offer tax concession for eligible family office as well. So we hope that all these can complement Hong Kong's competitive advantage that we already have, and to reinforce Hong Kong's position as a premier asset and wealth management hub. So I hope this can give you a very brief introduction as to the latest landscape of Hong Kong asset and wealth management business and all the efforts that we have put in reinforcing Hong Kong as a premier asset and management center. So you're very welcome to contact the SFC on any questions regarding OFCs via the designated inquiry mailbox which I've put on the slide here that we have set up for OFCs. And there's actually an OFC dedicated webpage on our website, which contains a lot of key information about OFC, including application forms in case you want to apply for one. So thank you.
Thank you, Grace, for sharing with us the thriving trend of OFC. So next, we will have Anson to share with us on Hong Kong's latest development as a private fund platform.
Thank you very much.
Yeah, Anson, please.
Thank you very much. Let me pull up my slides. So thank you again for Grace's presentation. That's very comprehensive, and it covered a lot of the points that on our part as well. So my part can be brief in the interest of time. I guess okay. So as Grace has very rightly pointed out in her presentation, the Comprehensive Fund Management Activities Survey by the SFC has already provided the audience some sort of high-level snapshot of how Hong Kong's asset and wealth management industry is performing now. So I'm not going to repeat many of those points. But I just want to highlight with the aid of this slide that if you look at the bottom left and the bottom right, this actually provides a very good time series as to how Hong Kong's private equity and venture capital AUM has been doing, as well as the number of fund managers in these areas have been rising. So you can see the trend is on the rise, and the bottom middle just shows in a snapshot view that in all of APAC, Hong Kong is the second largest PE hub as of now, trailing only after the mainland of China. So this is a traditional offshore fund structure, which I'm sure most, if not all, of the audience today would be very familiar with. So I'm not going to provide much introduction to that. Having said that, Hong Kong has been, like many other Asian jurisdictions, the fund management industry, in particular in private equity, has been using this offshore model. Having said that, this model is not without flaws. It's going to be increasingly challenged by different forces. Number one being the OECD, the intergovernmental force, originally putting together trying to combat tax evasion or tax avoidance. So this is the Base Erosion and Profit Shifting Initiative, or BEPS initiative of the OECD. The second, which I guess the audience today would be again very familiar with, is the AIFMD. In particular, this directive drove the asset and wealth management industry in Europe onshore a couple of years ago, leading to the rise of Luxembourg and other fund structures. The third challenge that the local and international fund management industry has been facing would be the cost increment as a result of all those different forces that we just talked about. To help the asset and wealth management industry, the Hong Kong government has mapped out a series of measures to help the industry. So that would include, of course, the OFC regime, as Grace has introduced, and also the in the next 3 consecutive years, we have rolled out different initiatives. For instance, the fund level tax exemption that Grace referred to as a unified tax regime in her presentation, and also the new limited partnership fund law, which was put together a year after that in 2020. So right now we just marked the second anniversary of the launch of this regime. In the celebration, we have right now have got more than 500 LPFs already set up under this regime. And the third is the carried interest tax regime, which was also brought into law recently. As we have another panel speaker today, who is Jing Jiang. He is a lawyer practicing funds, specializing in funds formation and other investment transactions in Hong Kong. So I'm not going to go through that many details on the operation of LPF today, but I just want to highlight a couple of points relating to tax. So when you set up a private equity or LPF structure, right now in Hong Kong, we've already established a system where at the fund manager level or at the GP level, you can benefit from the tax exemption under the carried interest regime enacted last year. At the funds level, you can benefit from the UFR or the fund level tax exemption that Grace and I have just talked about. And at the transaction level, there are enhancements made in the past few years, and the DTA network, the double taxation network that the Hong Kong government, the tax authorities have put together over the past years is so comprehensive that we try to look at the fund deals jurisdiction in APAC, and our DTA network actually covers about 90% of the jurisdictions in which these PE transactions are made annually. So this just gives you an overview as to what what private equity transactions would qualify under our tax regime. Basically, again, it covers more than 90% of private equity deals according to industry figures. So this is my last point that I would like to bring up, is that in 2 years, we have already achieved 541 LPFs established in Hong Kong. And this is, so to give you a sense of how this momentum is, if we look at the Luxembourg regime, which was enacted way before, in the first year, it has got around 200 something of the limited partnership vehicles. So for us, the last year we had the figure of about 300 something. So it would really, the team which put together this regime find it really rewarding that this regime is on the ground and is able to help the industry solve its problems mentioned earlier in this presentation. So with that, I'll stop, and I'll be happy to take questions in the panel discussion or after the webinar. Thank you very much.
Thank you very much, Anson and Grace. So please join us again in the panel discussion later. Moving on next, we will have Mr. Jing Jiang, partner of King & Wood Mallesons, who is also the founding president of Hong Kong LPF Association. Jing will be sharing with us how LPF aligns with similar structures in other jurisdictions. Over to you, please, Jing.
Thank you. I will share my screen. Can everyone see?
Yes, it's clear on the screen.
Okay. Good afternoon and good morning, everyone. So thanks again for joining this webinar organized by HKTDC, and also thanks for the sharing of by Anson and Grace. So today my topic is how the LPF regime align with similar structures in other jurisdictions. So in the past few years, I have done numerous webinars, but I think for European managers, probably this is still a very unfamiliar structure. So today I'm going to talk about this structure from the practitioner's perspective. So a bit introduction myself. So I'm a partner of King & Mallesons and also head of the funds practice. And as just mentioned, I'm also founding president of Hong Kong LPF Association and a council member of Chinese Financial Association of Hong Kong. I previously worked in a UK-based fund formation firms, focused firms, SJ Berman, which should be a familiar name for most of the fund managers in Europe, and it merged with KWM in 2013. That's how I come to KWM. So KWM has 30 offices globally, 15 outside China and 15 inside China. We have 5 offices in Europe as well. And KWM Hong Kong, actually, we have more than 30 years history in Hong Kong, and now it's the biggest law firms in Hong Kong. And also KWM Hong Kong is the headquarter, is our global headquarter. Our global CEO and the global COO are based in Hong Kong. And our funds practice are also consistently recognized as a top tier practice in Asia Pacific. So I think just in Grace's presentation and also Anson's presentation, they all mentioned a lot of effort has been put into place to make the fund management industry more attractive in the past few years. So if you look at this chart, there are indeed, from the introduction of OFC regime in July 2018, and in 2019, the unified fund tax regime, which Anson just mentioned, was introduced. In the same year, in August, the LPF was introduced and launched, and last year, the carry interest tax concession was introduced. Redomiciliation was introduced in November last year, and also SFC announced the government grant and subsidies to set up OFC and the REITs. And this year, we are all expecting the tax concession for family office will come into effect very soon. So this is a typical GPLP Hong Kong LPF structure. It's very similar to all the limited partnership structures in other key jurisdictions, like the UK, Luxembourg, Jersey, Guernsey in Europe, or Cayman Island, or Singapore. So if you look at this, we got a Hong Kong LPF. So in Hong Kong, if only the fund can be set up Hong Kong LPF. So if you are just set up a Hong Kong limited partnership, it cannot be registered as a limited partnership fund. There is another regime which is more than hundreds years old, which is limited partnership ordinance. So that's a common limited partnership ordinance. If you are the fund, then you can set up LPF, and you have a GP. And one thing I need to highlight here is that in Hong Kong, you cannot have more than one GP. So you can only have one GP here. And a GP need to engage a manager, but the manager could be the GP itself. And multiple manager are allowed. So for the Hong Kong LPF, you can have only one GP and multiple fund managers. And if you look at the left side, there is an authorized representative. So if the GP is not a separate legal person, say if the GP itself is a partnership, then you need to engage an authorized representative in Hong Kong to bear joint liability with the GP. And there is the other service provider, of course, the auditors, custodian, and fund admin. If you need to engage, then it will be based in Hong Kong. And the responsible person, which is a new concept, I think a unique concept in Hong Kong. Basically, its responsibility is to take care of the AML policy and the AML stuff. So it's like AML officer's role. And the GP, any company, but if it's a company, you need to be a Hong Kong company or a foreign company, but registered in Hong Kong as a non-Hong Kong company, or any individual. Being a Hong Kong resident or a non-Hong Kong resident, you can be the GP of the Hong Kong LPF. Manager should be a Hong Kong company or registered non-Hong Kong company, or a Hong Kong resident over 18 years old. And the LP could be any person, any person, individual, corporate or unincorporated entity could be the LP. The LPF must have an independent auditor and must appoint a responsible person, and only four types of person could act as a responsible person, either a bank in Hong Kong, or SFC licensed entity, or lawyers, or accountant in Hong Kong. And I think a lot of people who does not know the LPF structure will question like how the LPF structure and what's the feature, how is it different from the features of other key jurisdictions. So I will, in the next two slides, I will share my view about those key features of LPF, which I think it's highly aligned with those international practice. And actually, the background of this legislation is before the LPF ordinance is approved. The ANSENS team studied the limited partnership legislations in 7 key jurisdictions, including Cayman, Luxembourg, UK. Yes. So if you look at LP ordinance, it's very similar to those legislations in those main fund jurisdictions. And as a result, if you look at the key features, it's also similar. So the first 4, in Hong Kong, the LPF is not a separate legal personality. So it's not a separate legal person. It's everything need to be acted by the GP. And in Luxembourg, it's the same, like Luxembourg SCSP, which is the limited partnership in Luxembourg, is also does not have a separate legal personality. But of course, in Luxembourg and in many other jurisdictions, they have a structure which has a separate legal personality as well. The second feature is there is no minimal capital requirement. So you can set up the LPF with any number of LP or any amount of capital contribution. And feature 3 is you have the full freedom to contract. The GP and LP are having the total freedom to contract in terms of this commercial arrangement, about the terms of the fund, the GP and LP's interest and rights and obligation. The fourth feature is the LPF, unlike the OFC, the LPF does not need to be registered with SFC. And I understand in Luxembourg, it's the same. For unregulated fund, you can choose not to be approved by the regulator, but if you choose to be the regulated fund, then you need to be registered. But in Hong Kong LPF, you don't need to register. The fifth feature is there is a long list of safe harbor list. Later I will have a slide showing that. So it's very comprehensive. And a lot of LP or GP and manager, they're concerned the public access to LP information. So for that part, you don't need to submit all the LP information, either the identity and their contribution. You don't need to submit any information to the government or to the company company registry. So only the GP will have that information, and it's fully confidential. The next feature is the GP and the manager is not required to be licensed as long as it does not carry on regulated activity. So if the GP managing a fund, if the GP delegate all those day-to-day management function to a third party, say a Type 9 licensed entity in Hong Kong, or a qualified manager in other jurisdictions, say in the UK or in France or in Germany, it's all okay. So it basically means that the non-Hong Kong manager could manage the LPF as well. And it's not required to appoint administrator or custodian, as long as there are proper custody arrangement for assets. And the GP, the only requirement is that you need to, for all the service provider, you need to appoint an independent auditor. And of course, for the registration, you need to appoint a Hong Kong solicitor or Hong Kong law firm to submit the application form. Yeah, that's very different from the practice in other jurisdictions. You need a lawyer, a Hong Kong lawyer, to submit the application. And finally, the annual return. It's very simple. You need to file the return within 42 days after each anniversary of the LPF registration. And the return is only 2 pages. You just tick 2 boxes to confirm that in the past 12 months and in the next 12 months, the fund will operate as a fund. As I mentioned earlier, only the fund can be registered in LPF. So this is only to confirm that you are operating as a fund. And as mentioned before, there's a long list of LP safe harbor activities, and it's included in Schedule 2 to the LPF ordinance. There is a long list of 18 activities, and here is some of the key activities that usually LP would think of, like appoint a member in the IC, or appoint a member in the advisory committee, or participate in certain decision making. Those won't be deemed as a management of the fund. So therefore, the LPs will not lose their limited liability protection. And here's a statistic. Actually, it's more than the number that Anson just showed. So as at the end of October, so there are a total of 553 LPF launched. So given I mean, what happens during the past few years, the COVID and the economic, especially this year, I think it's the big achievement. So as mentioned by Anson, in the first 2 years after the SCSP was introduced in Luxembourg, it was around 600 registration within 2 years. For Singapore introduced their limited partnership structure in 2009, and until the end of October, there are only 608 limited partnership funds set up in Singapore. So basically, it takes only 2 years for Hong Kong to catch up Singapore, which I mean, it's quite amazing. So before I conclude my part, I just summarize the benefits of using Hong Kong fund structure. This includes the OFC structure as well. And for OFC, last year, I mean, as Grace just mentioned, it grows 7 times, around 7 times. The number of OFC grows 7 times. And the benefits is the strong momentum is because all of those benefits that people and the manager, both the manager and LPs, they see the benefits of using the Hong Kong fund structure. So first of all, in the past, before Hong Kong has its own fund structure, if the fund manager need to set up a fund, you need to go to Cayman Island. So if that's the case, then you're subject to the dual regulatory regime, both in Cayman and Hong Kong. But now if you set up the fund in Hong Kong, then you just need to follow the Hong Kong regulatory requirement. And as I just mentioned, there is the compliance obligation is quite minimal, because like LPF, it's not regulated. So you don't even need to register with the regulator in Hong Kong. For OFC, it's also, although it's need to be approved by SFC, but it's very straightforward, and the process is quite easy. And it's basically like a filing process. Another advantage is the Hong Kong, of course, it's a reputable international financial center, and it's not a tax haven. So for those entities set up in Hong Kong, it's much easier to open a bank account in Hong Kong. If you have a offshore Cayman structure, it's much more difficult to open bank account and those securities account in Hong Kong. And most importantly, the funds set up in Hong Kong have better access to China's PE and the capital market. As Grace just mentioned in her presentation, if you set up OFC, you can have access to wealth, the GBA Wealth Management Connect product, and also ETF Connect. And in Hong Kong, you can use we have the Stock Connect, we have the Bond Connect. So if you set up the Hong Kong fund, then you can easily access to the PE and the capital market in mainland China, and a lot of I mean, when people set up funds, one of the most important consideration is tax, and as we mentioned, both at the fund level and manager level, there are tax exemptions. So if you are qualified, then the profit and the investment return should not be subject to any tax. And if you are PE fund investing in private companies, the carry interest received by the GP or the manager could be exempted, and also the salary paid out of those carry interest or salary or bonus out of those carry interest paid to the employees will be exempted as well. So those employees will not need to pay salary tax for those carry interest. And as Anson just mentioned as well, Hong Kong has a double taxation treaties with many countries and in Europe, like France, UK, Luxembourg, Switzerland, Netherlands. So Hong Kong has a very good network of double tax treaty. So if you use a Hong Kong fund to make investment, you can benefit from those tax treaty as well. And last but not least is a low establishment and maintenance cost. So as Grace also mentioned, for OFC, they charge, especially private OFC, there's basically no annual fees paid. I mean, if you ever manage a Cayman fund, you can see every year you need to pay few thousand US dollars for each entity you manage there. And for OFC, of course, there is even a government grant, whether you set up OFC or you redomicile the OFC from other jurisdiction to Hong Kong, then you can get 70% of your professional fees paid to the local professional service providers. Yeah, subject to a cap of 1 million Hong Kong dollar. So that's all the key benefits of using Hong Kong fund structure. So I think I will stop here and will share and discuss with the panel later.
Thank you very much, Jingjing, for your insightful sharing. Please join us again later. There will be a Q&A section following the panel discussion. Please feel free to submit your questions via the Q&A box, and our speakers will try to answer your questions afterwards. Without further ado, may I now pass the time to our moderator of this section, Mr. David Sid, Assistant Principal Economist, Asian and Emerging Markets, Research Department of Hong Kong Trade Development Council. Over to you, please, David.
Thanks, Fiona. Good morning, our friends from Europe, and good afternoon, friends from Hong Kong. Thank you again for joining us today at this webinar. I'm David Sid from HKTDC Research. Today, we are very honored to have a distinguished panel with regulators and professionals to share with us their insights. In addition to our speakers, Ms. Grace Cheng from SFC, Mr. Anson Law from HKMA, and Mr. Jingjing Jiang from Ken & Wood Medicines, we have two asset management professionals from Europe joining us today to share their perspectives. May I now introduce Mr. Nick Touchett, Chair of the New Markets Group at the City UK, Deputy Chair of UK Investment Association Trade and Investment Committee. Hi, Nick.
Hi, David. Hi, everyone.
And Mr. Stephen Jenner, Head of Global Regulatory Developments and Public Affairs, Asset Investment Managers, and Co-Chairman, Asset Management and Investor Council, International Capital Markets Association. Hi, Stephen.
Hi to everyone.
Oh, hi. Okay, let's begin our panel discussion. Well, thanks again for Grace, for Anson, and Jingjing for your wonderful overview of Hong Kong's new initiatives of the field, as well as a comprehensive introduction and comparison of the scheme. So I would very much like to hear from a European perspective. How does this Hong Kong new initiatives step up Hong Kong's appeal as the hub for asset and wealth management from the perspective of European wealth management sector? So why don't you begin first, Nick? Oh, well, I hope the question is not too difficult for Nick. Yeah, he's coming back. Hi, maybe Stephen can give us some views first.
Yes, Thank you very much for the question. First of all, speaking on behalf of AXA Investment Managers, I want to remind that we set up our legal entity in Hong Kong a long time ago.
Yeah.
AXA IM, as an asset manager, a global asset manager, we are in top 25 globally and top 5 in Europe. As AXA Investment Managers was set up globally in 1994, but only 4 years later, in 1998, we set up AXA IM Asia in Hong Kong. So one was of the first subsidiaries we set up in Asia, I mean, in the world, but including in Asia. And so it shows our commitment to Hong Kong, and it's a hub that we call Asia Hub, Asia Pacific Hub for the overall Asian region. Number two, we have now around 100 people working there, not only in the marketing side or client relationship side, but also in managing portfolios from Hong Kong. We have a portfolio managers team. And in addition to that, we have also a trading entity, which is trading, making trading from Hong Kong. So just to show our long-term and substantial commitment to Hong Kong for long. The second point I wanted to mention regarding the further developments of the fund industry from Hong Kong, definitely the huge and obvious benefit is the connection with the closer region, the Greater Bay Area, and in particular also, of course, mainland China. So we are hoping that the new schemes that you are currently launching will be able to develop further through those Greater Bay Area and China Connect. One point, and last point, before passing the floor to my colleague from the UK, Nick. Last point, it's very important, in my view, for Hong Kong authorities and industry as well, to be vigilant indeed, it was mentioned before, about current EU regulatory developments to make sure that the fund design elaborated in Hong Kong follows the trends, in particular from the European Union. For your awareness, today, the UCITS regime and the AIF regime in Europe are currently under review, and typically we will be benefiting from some provisions on liquidity management tools. So it's one aspect to be followed carefully, I think, for Asian funds, in particular Hong Kong funds in the medium term. And also, we are going to elaborate at EU level a harmonized regime for loan originating funds. So maybe it's also another point to be aware of. Last point, from an EU perspective, the EU has launched a few years ago a so-called European long-term investment fund, investing in private equity or in real estate or in infrastructures. It is currently reshaped, I would say, to facilitate the wider access of by investors into longer-term investments such as private equity, real estate, or infrastructure. So LTIF review currently under finalization in the EU should be also very carefully be looked out by both regulators and industry players from Hong Kong.
Yes, I think that the development of regulations in EU, we should pay attention very closely as well. Well, I guess Nick has some issues about connection. Nick, are you back with us?
Yes, I am, David. Apologies for that. Perhaps I can make a few comments whilst I have a good connection. I think you're interested in the perspective from the UK in terms of increased allocation to.
Sorry, Nick. I think you yeah, please go ahead.
So I was going to reference what Grace had said about Stock and Bond Connect and the allocations to China from the UK and from Europe more generally. We've also seen with the inclusion of China in various indices, that European investors strategically are taking the opportunity to invest into China. So that would be, sovereign wealth funds and also retail investors across the region. And my experience as a board member of Invesco UK, but also of the Dublin Funds Management Company, which is very similar to the OFC structure. It's interesting that in EMEA, some research was conducted by Invesco a couple of years ago that I commissioned. In European investors into China, 33% of them were doing it for strategic regions, 50% for thematic reasons, and only 17% for tactical reasons. So I think the development of ESG and China regulations is one of the drivers for European investors to be exposed. Hitherto, it was generally through offshore funds denominated in RMB, but this regime is going to seriously help the onshore business.
Well, Nick.
European investors is through the distribution opportunity into the Greater Bay Area. The Greater Bay Area, we believe, could be one of the fastest growing parts of the global economy going forward. And I think this is a real opportunity for European, including UK managers who are looking to gain more exposure to China without the more sort of complicated Cayman or offshore structure. I think, we talked about the family office opportunity, but I also think the bank platform opportunity is going to be a real one for unit linking life funds, but also for bank assurance funds as well. So hopefully you picked up most of that, but I think the introduction of the Greater Bay Wealth Management Connect scheme as well, that's going to again increase access and the ability for firms in Europe to connect into this region. So David, hopefully the signal didn't break up too much and you got the gist of that.
Well, I'm sure we got the gist of it, and you are very optimistic about the opportunities in GBA. And definitely Hong Kong is the good gateway to invest in not only in Hong Kong, but in the Greater Bay Area, mainland China, and perhaps even the Asian region. So I would like to ask Jinjin to follow up with that. Well, you've been in Hong Kong and you assist more than 400 of the setups. Do you have any particular tips, practical tips for our European friends if they want to set up a funds in Hong Kong?
Sure. I think if they want to set up, I think it's very easy to set up in Hong Kong. It's just to engage us. We can help them along the way. So for LPF, of course, I mean, you need to engage a Hong Kong, as I said, you need to engage a Hong Kong solicitor to submit an application. And if the manager has a local Hong Kong fund manager, say like Stefan, he just mentioned, they have a Hong Kong company, got a Type 9 license, then it's easy for them to set up both OFC and LPF. And although LPF, to set up LPF, as I mentioned before, you don't need to be licensed, as long as you delegate those day-to-day investment function to a qualified fund manager, either in Hong Kong or out of Hong Kong. So basically, if the fund manager in Europe, say a UK manager, want to set up a fund in Hong Kong, LPF, but does not have any subsidiary in Hong Kong, they can definitely set up and manage LPF from out of UK. And other than those benefits we mentioned about those GBA Wealth Management Connect, ETF Connect, which are only applicable to public fund for now, including mutual recognition. But for private fund, if you set up, because if you look at the number, more than 70% of the OFCs are set up as a private OFC. And the LPF, all of them are private and mostly closed-ended fund. And now actually in the GBA areas, there are another connect, what we call PE Connect. Probably it's for a lot of people, it's a new thing because this is just a new concept, which was introduced 2 months ago. We don't call it PE Connect, but under the GBA areas, if you set up LPF, and if you have, you can easily set up what we call qualified foreign limited partnership in Shenzhen, Qianhai. So in that way, and also if you are a fund manager in Shenzhen, Qianhai, you can easily set up a QFLP, use the QFLP or QDIE. QDIE is like QD basically, but for private equity. So you use the QDIE to invest offshore through the LPF. So there is what we call 18 measures. What we call 18 measures was announced 2 months ago, and I was involved in part of the drafting of those legislations. And now they will roll out detailed implementation rules going forward to further facilitate the PE connect between Hong Kong and the GBA areas. And the GBA areas will, through GBA areas, you have access to the whole mainland China. So in that regard, I think it's also got a lot of potential as well for private equity fund managers. Yeah.
Yes, definitely. Those new initiatives, just like you said, has provided a lot of new opportunities for private equity funds from all around the world, particularly from Europe, to explore the opportunities in Hong Kong. Well, regarding the regulations, does our regulators have anything to add, Grace or Anson, about the perhaps some new in response to Stefan's remarks on European regulations?
Actually, in terms of regulations, we have maintained a very close dialogue with all the overseas, including European regulatory authorities. Actually, in fact, I don't know if you're aware, we have an organization called IOSCO where all the regulators will meet together and consider regulations and discuss new regulations or areas that they need to pay attention to, and Hong Kong is actually a very active member in IOSCO. So we actually keep a very close dialogue with our counterparts, especially those in Ireland, Luxembourg, where a lot of, as you may know, a lot of UCITS fund has come to Hong Kong and get authorization. So we do keep a very, very close dialogue with them. So if there's any need that we do review our regulations from time to time in view of market and regulatory development. So you just be reassured that our regulations will be appropriate and up to date and will take into account any regulatory developments in other overseas jurisdictions.
Just at a point that in terms of the LPF legislation, when we drafted the law together with the administrative part of the government, we did make reference to a lot of other jurisdictions. For instance, the Cayman Islands, Luxembourg, the US states of Delaware, Australia, United Kingdom, Ireland, and Singapore. And what we got was basically the highest common denominator of everything in the jurisdictions that I mentioned that worked for the industry. Plus that the legal system of Hong Kong is basically inherited from the UK common law system. So I can confidently say that any fund managers trying to set up a fund vehicle using either OFC or LPF, you would find the documentation very easy to understand, the preparation very straightforward. And for instance, the LPF, if you compare the LPA, the limited partnership agreement under LPF regime, with any other jurisdictions that I mentioned or any other, internationally recognized fund structure jurisdiction, the regimes are going to be very similar. The LPA is going to be highly comparable with one another.
Yeah, sure, definitely. I think Hong Kong is taking very active step, as I can see, to move towards a much easier platform and to be a better hub for wealth and wealth management and asset management. And of course, if European funds would like to come to Hong Kong, you're more than welcome to reach SFC, and of course our professionals here, which can definitely help you to move to Hong Kong. Well, perhaps then we can move on to the Q&A sections, because we are seeing quite a number of questions flooding in. So we should let the audience to have a chance to ask the questions. Now, first of all, this question might be directed to Nick and Stefan. What do you see are the key industries or sector that European funds would be shooting after in the next 5 years, say? Yeah, maybe Nick first.
Yeah, sure. I mean, I think it's around technology, to be honest. One of the things that we noticed from the UK is the real interest that investors have in technology sectors. So around sort of AI, automation, automotive industries. That's a key area. I think actually the one area that might be overlooked is that around financials as well. I mean, currently, I think banks in China are only about 10% owned by overseas investors. So I think financial sectors, but generally towards tech. As I said earlier, the theme of ESG.
Yes, I guess I heard you talk about ESG as well, right? Yeah, I think I agree with you.
Yeah, through
yeah.
Yeah.
We are having very active scenes in Hong Kong and of course in this part of the world in terms of fintech, in terms of startups, or especially or even in ESG and health tech. Anything you would like to add, Stefan?
Yeah, definitely to complement what Nick was saying. Indeed, I think that one of the I would say holistic or a transversal approach that we are really looking at from a global perspective, including vis-a-vis Asia and Asian investments, is the embedding of ESG indeed.
Yes.
For a long time, AXA Investment Managers has been an ESG active manager, fund manager, and definitely it will be a critical parameter that we will enhance in the future even more, considering also the globalization of the concern regarding sustainability and ESG. And definitely, for instance, the development of green bonds in our case is very significant in terms of investments, in particular towards Asian issuance of green bonds. So just to say it, ESG will be our key factor and key parameter in the future for our investment, including in Asia and including possibly in Hong Kong.
Yes. Well, actually, as far as I know, Hong Kong is the one of the most popular issuance destination for the ESG bonds. We are actually leading in the region, which I think this, of course, helps from the support of the Hong Kong government, but actually also by the industry. So this is actually the place for ESG finance and funds. And yes, definitely, I agree with you on that. Yeah, we should look at ESG as well. Well, does Anton has anything to add from the perspective of MA? I know that MA do have a lot of initiatives in encouraging the investment on the new frontiers, like ESG.
Yes, David. Pretty much the bond grant scheme, the green bond grant scheme, and the tokenization project are all driven by our different teams within the Hong Kong Monetary Authority. So we're very excited in terms of developing the market, attracting more more players to Hong Kong and new capital to Hong Kong. We'll just continue with our work and make more announcements as to our future plans and what's exciting to the industry through your platform and through other means.
Yeah, definitely. To further step up Hong Kong's position as the green finance hub is one of the mission of Hong Kong. Well, there's another question coming up. For European funds managers coming to set up funds in Hong Kong, what would be their main concerns? Well, perhaps did you see any challenges or do you have any concerns about setting up funds in Hong Kong for our European fans? Yes, maybe Stefan can begin first.
Whoever. So yes, what is critical when setting or launching a fund is to see first what are the needs or the requests from investors. So we try always to adapt to our clients' requests or needs. I think that one of the challenges in fund domiciliation of countries which wish to develop their local fund range is probably twofold. Number one, to make sure that investors potentially are aware that such local funds present advantages, because there is a sort of herd behavior by investors. When they are used to invest in, e.g., a Lux fund, we are also offering a Lux fund, of course, or Irish funds. When investors are used to be offered such a type of fund, sometimes it takes a time to educate them, to tell them that alternatively located or domiciled funds may be as convenient and sometimes even better. But so that herd behavior from investors in being used to ask for a Lux fund or an Irish fund, sometimes it's a sort of a difficulty or challenge for alternative fund domicile countries to compete. This is one point. And the other point is also about facilitating fund subscription. It's more technically or technologically driven. Definitely, I'm thinking here about DLT and blockchain.
Yes.
I think currently in Europe, at least in Europe, there is the development of blockchain for fund subscription and redemptions. And as an example, at AXA IM, we have already launched some EU domiciled funds. In that case, it's French funds for French clients specifically, with subscription and redemptions in DLT, in blockchain. And I think it's also a way to facilitate the subscription in funds by investors, in particular by professional investors. And so I think it's also one technology which has to be part of the design of when a marketplace wants to develop a new type of fund. It's important also to think about that technological aspect. And I think that DLT development will facilitate the fund subscription. But so the local city center, the local marketplace must take that technology on board to facilitate its own locally domiciled fund range.
Yeah. Well, definitely. I think the blockchain part actually catch my attention. Hong Kong is actually one of the most important hub for blockchain and crypto assets as well. And we are aspiring to be, we are seeing a lot of issuance, even for coins or for NFTs. So these are the opportunities that we are yet to explore. Yeah, maybe Nick can add on that as well about.
Yeah, David, maybe I can add to that. There's a few factors, I think, in Hong Kong's favor when you're looking at it from a European-based asset manager. Firstly, you've got this very deep ecosystem and experience of asset management, wealth management. You've got talent, really strong talent in the marketplace, very good corporate governance, and experience to product development. So I think Hong Kong's a very attractive location to be based to work in the region.
Yeah, definitely. Well, there's another question coming up. Well, this is direct to Nick. Well, could Mr. Nick to elaborate how LPF and OPF benefit insurance company investment-linked funds?
I think it's transparency. The fact that you're not dealing in an offshore structure, it's going to sit on a life company platform a lot more easily, and I think it's a well-established route. So it would be like putting Lux or Dublin funds on a life platform. It is quite a sort of fungible exercise.
Yes. Okay. Yeah. So I think that actually benefits the funds in terms of transparency, and that's very important. And there's another question that's coming up as well. How do OFC and LPF regime enrich the opportunities for family office and wealth manager in Asia and in Hong Kong? Perhaps Jinjin can also add on that as well.
I think the family office are closely connected with fund management, because for family office, if you are talking about a single family office, then they normally act as an LP, investing funds. And for multi-family office, they are actually, a lot of them, they hold a type license in Hong Kong, so they can act as an external asset manager. So they can play both roles. And Hong Kong, as mentioned before, as actually in the John Lee's policy address last month, he mentioned in the next 3 years, by the end of 2025, the Hong Kong government is going to attract 200 family office in Hong Kong. So that's the KPI for the government, for the family office Hong Kong. And I think definitely the infrastructure that the Hong Kong government set up for the asset management definitely pave a very good fundamentals to attract those family office to come to Hong Kong, because a lot of family office, they set up their family office in the form of fund. It's very common to set up an LPF or OFC, and now apparently it's become much easier and cheaper to set up and maintain those fund vehicles in Hong Kong. And as mentioned, there is a redomiciliation mechanism and regime introduced at the end of last year, and so far there are a few successful cases that I'm lucky enough to act on the second redomiciled case from Cayman to Hong Kong, and that's for family office, because they think the Cayman SPC Cayman company corporate structure, it's corporate fund structure, it's very expensive to maintain. So that's why they decide, especially for small and mid-sized funds managers, so they can save a lot of cost when they move to Hong Kong. I don't know whether I mentioned it before or not. The average when we do the calculation, the average maintenance cost for LPF, it's in the range of 20% to 35% of the average maintenance cost in Cayman Island. So that's a really advantage and the benefits for the family offices. And as mentioned, the next year, the family office tax concession will take effect as well. So by then, the single family office, if you set up a single family office in Hong Kong, it does not mean you need to put all the money in Hong Kong. As long as you set up an office in Hong Kong, both your onshore and offshore structures would benefit from that tax concession. Yeah.
Yes, definitely. So we are seeing a lot of benefits with the new regime in the space of a family office.
Yeah.
So we are running out of time because
and also I saw one of the question is asking where one of the audience asked where for the PE Connect and regime, which website can we find the latest regulations announcement? So if you just type in Google it, 18 measures and the KWM, you can find articles and announcement.
Well, that shows the importance of following up with the latest development in the regime. So, yes. Well, we are running out of time. We have a lot of questions, but yeah, we are running out of time. So, can each of you give us some concluding one or two sentences of concluding remark regarding the Hong Kong's position as the ideal asset and wealth management hub? Perhaps, Jing, you can, as a local expert, can you give us one concluding remark?
Yes, I think it's very simple because I have, in the past 2 years, since the LPF was introduced, I act for nearly 30% of the LPF in the market and also work on a lot of OFC setup, work with the managers globally from everywhere. So I can see that people are becoming more, because as Stefan just mentioned, I mean, you need to be familiar with this structure. So I think now more and more non-Hong Kong managers, the global managers, they are more familiar with the LPF. So an OFC structure, you can see the last year they increased by 8%, about 8 times, not 800%, right? So yeah. So it can tell, yes, how popular and the momentum it gains in the past years. So I'm very confident with Hong Kong opening up to the international market. Now it's very easy to come to Hong Kong. So I really encourage all those European fund managers to come and look and feel the dynamics in Hong Kong. And Hong Kong is like John Lee said, Hong Kong is back on stage. Yeah,
sure. And Nick?
Yeah, just really quickly to say there's clearly very encouraging momentum that Hong Kong has in these developments. You know, managers are looking for, you know, transparent regimes that are simple to deal with, and you know, I think we look forward to continuing to build these relationships. Hong Kong's a key business partner for the UK. And as I said earlier, you know, the pool of talent there, coupled with the regulations and the distribution opportunity into the wider region, I think is a really good combination.
Yes, definitely. And Stefan.
Yes, to echo what Nick said, definitely. And once again, I'm mentioning our own figures in terms of setting in Hong Kong for a long time. We deeply think that in terms of skills, this is definitely a key country in the region for asset managers, including global ones, maybe not only global ones, but including global ones like us. So we are very keen to continue collaborating and exchanging with the authorities in Hong Kong to facilitate.
Thank you for your long-term support. And anything from Grace and Anson from the perspectives of regulators and government?
Yeah, actually, we are very determined to develop Hong Kong's asset, maintain Hong Kong and continue to develop Hong Kong asset management industry. If there's any questions everyone has regarding our regulations, very welcome to contact us. If you want to set up an OFC, very welcome to contact us. And we've actually been receiving a lot of inquiries from industry practitioners, and we've been, giving them a lot of hopefully good advice. So just welcome to contact us. Yeah.
I think Grace is spot on, and just want to add one point that as part of government, HKMA has been working very closely with the government administration in terms of rolling out all the various initiatives, building Hong Kong into a stronger international financial center. So as you can see from Grace's and my presentation, a lot of measures, basically 1 year, one major rollout of major measure, and we can confidently say that in the coming years there will be more good policies, more market-friendly policies to roll out. So stay tuned.
Yeah, sure. I'm sure that our audience are very eagerly looking forward to Hong Kong's new further initiatives and good perspectives. And well, very interesting and insightful discussion and very good Q&A section. Thank you very much to our panelists and all the audience staying with us today. So this marks the end of the panel discussion and Q&A. Now, over to you, Fiona. Thanks.
Thank you so much, David, and all the panelists for this very fruitful discussion. And thank you everyone for staying here and joining us today. I hope we have contributed to your understanding and interest in Hong Kong's role in the asset and wealth management landscape. The replay of this webinar will be available on the LinkedIn page of the Asian Financial Forum. Under the overarching theme of AFF, Accelerating Transformation, Impact, Inclusion, Innovation, the next edition of the Asian Financial Forum is taking a three-pronged approach towards the most concerning global issues and disruptive ideas that might topple the socio-economic landscape. And we certainly hope to see you in person in January next year. For now, please stay on for a short video to recap what we've discussed and showcased in the last AFF.
The financial sector has moved from being a mirror that reflects a world that hasn't been doing nearly enough to become a window through which ambitious climate action can deliver the sustainable future that people around the world have been demanding and which future generations deserve.
But it is important to not only look at what the next normal will look like, but also what it should be. When we navigate our economies towards a more resilient future, we should also take the opportunity to make the future more sustainable and to be better prepared to address another imminent global issue, climate change.
Because as the sustainable finance market is starting to mature, financial institutions and corporate have to step up the game and not just talk about it anymore. Because if you look at the regulators, including both the HKMA and SFC, are tightening all the standards for the asset manager claiming to invest sustainably.